Well, Newscape Capital, I joined a year and a half ago. So prior to that, I was 17 years at HSBC as head of absolute return, managing a significant series of funds, which we started in 2002. And I left there and came to Newscape, set up by Steve Decani in 2008. I joined really to take over the fund business. They had a small fund business here, which I thought was a good opportunity to try and grow. And we've only got two funds, and we've got lots of white label funds. And so the white label funds are third parties who can host their funds here and that sort of thing. But the funds that we run ourselves are mine, which is diversified growth, and my colleagues, which is emerging markets. And do you want to hear a bit about diversified growth? So I run the Newscape Diversified Growth Fund, and that is essentially a multi-asset fund, which is got an absolute return leg to it. So the idea is to try and keep up with the stock market, but try not to lose all the money in a bear market. A very simple objective. And so we do that by having, the first thing is asset allocation, but I don't really mean asset allocation of everything, I just mean how many equities. Right? So the percentage of equities is the most important decision in investment, frankly. So if you've got, right now we're about 50, we could be as high as 80, we could be as low as nothing. So there are lots of ways we try and understand how much equity to own. And the idea is really to be out of the market in the bear market. Part of it's fundamentally driven, part of it's technically driven. So we're putting any data source we can find to try and give us an advantage to make sure that we've got the correct amount. And the second thing is what kind of equity we have. And we're global, we're agnostic, we don't care about countries and sectors and in some sort of benchmark manner. We hold equal weights, so every stock is 1% holding. And but the most important point is we diversify by factor. And what this means is the interest rate environment. So if inflation is rising, then that means money is bad. So that means you want to own real assets. Yeah. If inflation is falling, then money is good. So you want to own stocks and bonds. And we have this regime to help us to go into countries. We track 24 different countries in this way. And of course, I sit next to an emerging markets fund, so it's very useful. So recently, for example, we had a signal in Russia that told us that inflation was falling. That means the Russian ruble is good. That means you buy it. Yeah. And we're seeing at the moment inflation expectation in America is rising, so that's negative pressure on the dollar. In the UK, we've had a very weak pound this last year because of Brexit, but that inflation has peaked and is now falling, so the pound is now rallying. Yeah. So you can see there's a logic to this, and we follow this everywhere to try and understand where we want to be. Now, that neatly brings me on to the pound. So there's a big problem for my clients if the pound goes up because international assets are bad. And so we have a currency hedge on the pound against dollar and against euro. So that protects. Now, we can have a share class in anything. Yes, we currently have sterling share classes, but we could have other share classes and reflect that view. Then there's stock selection. So we look for the best companies in the space that we're trying to identify. So high quality companies like the highest quality company of all would be Nestlé, something like that. Now, those sorts of investments only really work well when inflation is under control and when bond yields are falling. And right now, we think that bond yields are as low as they can go, and the risk is that they rise. It's very unlikely they fall considerably or substantially from here. Yeah, so we don't actually like those companies anymore. We think they're a bit dangerous, and we prefer reinsurance and actually utility companies. So we've been buying into European utilities. In fact, one of them just got bid. Uniper in Germany just got bid for just a couple of days ago. But you can see that there's a pressure on electricity pricing, not just in Europe but also in the States, and that's quite interesting because I think there's been so much investment in alternatives. And I guess they don't work as effectively as the traditional electricity sources. And so you can see the pricing is quite firm. So we've bought into utilities rather than the consumer stocks. Then in the growth area, when we think inflation is low but interest rates are falling, so the economy is doing well, then we've had a lot of healthcare, biotechnology, internet companies. So those are the sorts of areas we've been in. But the valuations are now not as attractive as, we find it quite uncomfortable with many of them. So we have some of the big names, but increasingly we're making sure that we keep our holdings liquid. But we have got some very interesting companies, for example, one in New Zealand, a high growth company called A2 Milk, which we've owned for a year now. and it just seems to go up every single day. They make lactose intolerant milk, which is sold to the Chinese market. And I've never seen a young company grow so quickly in my life. So it's incredible what's out there if you have a global approach to investment. But our biggest position right now is in value. So as I said, we've got less in defensives, we've got less in quality in defensives, we've got less in growth, but we've got lots in value. That's because we think that inflationary pressures, generally speaking, are more likely to rise than fall. And it's also because we're not extremely bullish on the economy, but relatively bullish on the economy. And so that means that the Chinese currency is strengthening. That puts inflationary pressures around the world, and it just tightens the system. So therefore, we've got some mining stocks, we've got a lot of oil. So oil is something we're very, very bullish on right now. I mean, at the time of this interview, it's $50, having visited 27 last year. But there's a lot of complacency, again, going back to that electricity market. In the oil market, there's a sort of feeling that we don't need oil anymore. We've got electricity and electric cars. But if you add it all together globally, there's going to be a squeeze on energy over the next few years. And there's far too much complacency on alternatives. So we've got a big position there. And then we also own financials because we think that the dividends are going to start coming through soon. I mean, they already have done in the States, but increasingly in Europe we'll see higher dividends. And when they do, I think people will be shocked on quite how profitable the banks are again. People sort of forget. In Britain, we've got companies like Lloyds, and we've also got Standard Chartered. Lloyds started paying a dividend fairly recently, but Royal Bank of Scotland could start paying a dividend, and also Standard Chartered. And it's all going to happen probably next year. So I think as people realise how good these dividends are, then the share prices will be re-rated. And then finally, there's gold. We've got a small amount of gold, not a huge amount at the moment, because for gold you need to see interest rates fall and you need to see inflation rise. And we don't really see that environment. We can see inflation rising, we can't see interest rates falling. So therefore, if we thought the economy was slowing down in an inflationary environment, we would have lots of gold. But right now we just have a bit. So I hope that's the point. So we scale our position size according to the conviction of the view. But the key is to be diversified. So we never have, we wouldn't put the whole portfolio into value and ignore the other parts. The idea, by having a bit in everything and just scaling it slightly, you have extremely low volatility. You'll find that my funds basically kept up the stock market this year, but the volatility has been extraordinarily low.